Hey guys, it's a question I've been getting from clients quite a bit in the past month, and so I decided I should make a video on it. So what am I talking about? Well, I'm talking about how dividends are taxed in Canada. Couple of caveats. Number one, we're going to be focusing on the federal level for the sole reason of keeping it simple. The second thing is that this is for general information purposes only. It's not going to make you qualified to be a corporate tax expert or do corporate tax planning or really even file your own corporate tax return. So what is a dividend? Well, hopefully a corporation will generate a profit. That profit is either reinvested into the business or it's paid out to the owners, i.e. shareholders. When a corporation pays out the profits to owners, we call that a dividend. So now we're going to step into this thing called the small business deduction. So the small business deduction is available for small businesses in Canada on their first $500,000 of profit. Basically, it results in a pretty significant reduction in tax rates for that corp. It's available for these things called Canadian Controlled Private Corporations, or CCPCs. There's a bunch of criteria for what makes you a CCPC, and in most cases, a private corp in Canada qualifies as one. But we're not going to get into that here. All you need to know is small business deduction equals big tax savings for a corp. In the tax system, there's really two types of dividends. This really only matters for tax purposes. At the end of the day, it's still money paid out of the profits of a corporation to the owners. From a tax perspective, there are really two types of dividends, eligible and non-eligible dividends. Do you remember the small business deduction, how it gives a reduced tax rate? Good. Remember how dividends are paid out of the profits of a corporation? Good. Okay, now let's tie this together. Eligible dividends are dividends that are paid out of the profits of a corporation that did not benefit from reduced tax rates. Non-eligible dividends are dividends that are paid out of the profits of a corporation that did benefit from reduced tax rates. Generally speaking, personal tax rates on eligible dividends are lower than personal tax rates on non-eligible dividends. So, at the end of the day, eligible dividends equals more tax at the corporate level, but less tax at the personal level. On the other hand, ineligible dividends equals less tax at the corporate level and more tax at the personal level. Pretty straightforward. Now we're going to talk about dividend buzzwords because everybody loves dividend buzzwords. Those are a lot of fun. A lot of this stuff is not really going to be all that relevant to you unless you're preparing and filing tax returns, but it's still good to know. So we're going to start with the dividend gross up. Dividend gross up. You can think of it like this. Imagine you receive a dividend of $1,000 from a company you own. Basically, the CRA goes, you know what? Let's just pretend that you actually received $1,160 and we'll tax you on that. Cool? Not cool, but that's how it works. No reason to get upset yet though, because we have this great thing called the dividend tax credit to balance it all out. So the dividend tax credit, one of those things that really illustrates how convoluted or ambiguous the tax system can be. See, you can think of the dividend tax credit as the CRA having second thoughts about being so aggressive and hurting your feelings with the whole gross up thing. So, they give you the dividend tax credit to try to make it up to you, which essentially reduces some of the tax you pay on dividends. Good work, CRA. So next, we're going to move on to this thing called the GRIP, also known as the General Rate Income Pool. It is an account for a CCPC, or Canadian Controlled Private Corporation, that tracks the profits that were taxed at full corporate tax rates. The amount in this account is the amount that a CCPC is allowed to pay out as shareholders as eligible dividends. Cool! The LRIP is the next topic. That is the low rate income pool. It's an account that tracks the profits of a non-CCPC that were taxed at favorable corporate income tax rate and benefited from what? Reductions in corporate tax, hence the low rate. It's the amount that a non-CCPC has to pay out in non-eligible dividends before it's allowed to pay eligible dividends. So, GRIP equals general rate income pool, the amount that a CCPC is allowed to pay out in eligible dividends. The LRIP, low rate income pool, is the amount a non-CCPC has to pay out in non-eligible dividends before it can pay eligible dividends. Not too complicated. Now our last topic is things that are probably worth thinking about when it comes to dividends. So the first thing is that dividends are not considered earned income. Why does that matter? Why do you care? Well, I'll tell you why. Earned income is what determines your RRSP deduction limit. Since dividends are not earned income, it does not increase your RRSP deduction limit. So, if you're looking to make contributions to an RRSP, you need to have some earned income to be able to do that. The second aspect of dividends not being earned income is there's no requirement to make CPP contributions. So, in a year, the CPP rate, assuming you're at the maximum rate, is something around $2,500 for the employer and $2,500 for the employee. If you're an owner-employee of a corp, that's about $5,000 out of your pocket. So if you don't plan on relying on the Canadian pension plan for retirement, dividends might be a good option, because then you can take the money that you save and invest it in something else. The last thing is that dividends are not deductible for tax purposes. And what do I mean by that? Well, the corporation pays dividends out of after-tax profit. So it's not deductible as an expense. So let me do a basic example for you. If a corporation that earns $10,000 pays a salary of $5,000, it is taxed on $5,000 of profit. If the same corporation pays dividends instead, it is taxed on $10,000 of profit. If we assume a tax rate of 10% to make the math easy, the difference is $500 in corporate taxes paid versus $1,000. So, hopefully you've learned something from all of this, or it's at least given you some general understanding of how dividends are taxed in Canada. If you're looking for help with any of this, if you have any questions or comments, or you want to understand better, or you have an idea for another video you'd like me to make to provide some clarity on all of this, just let me know. Comment, message, email, call me, carrier pigeon, whatever. If you need help with some tax planning, we're always here to help. Get in touch with us. Thanks for tuning in, and see you next time.